Well, good morning once again, everybody. This is Jeanette Sims. I'm broadcasting from Mobile, Alabama, in this morning's Trade Thirsty 3 Market Mastermind. I almost called it a Mackermind. Maybe we should change the name to Mackermind. How are y'all doing today? Tell me where you're from. Always love to see where people are dialed in from around the world. It's never just around our country anymore. It's around the world. It is a balmy 55 here this morning in Mobile, Alabama. I just got back from beautiful Mexico and sunny Playa del Carmen, where I spent 6 days, and it was so nice. I'm a summer girl, so I miss summer when I don't have it. It's nice to get away from this. When I left here, it was 29, so it was quite a shift. Western Burbs, Chicago, not 55 degrees. That's right. In January, and said no one ever. 55 in Chicago. Montreal, UK. We've got some UKs up in here. I like it. Sunny British Columbia. It is sunny. I'll give the Lord that this morning. It's beautiful outside. So I'm fighting a nasty cold over here, like I said earlier. So y'all just bear with me. I'm trying to make sure that I don't cough in your face. If you'll see on the screen, you'll see our 3 speakers for this morning. I'm pretty excited to say we've got new speakers with us this morning who've never been on one of our multi-speaker events today. And so hopefully you guys will enjoy it like we do. Hubert and I, when we built this company, it was to bring you good quality content from people that we know or are very well acquainted with in our industry, because we know there's a lot of people out there that are slinging stuff that isn't going to help you be a better trader. People that don't have great reputations in their community. But for us, it's very important that we bring people in here that we know you're going to get something from in the 1 hour that we give them. So if you guys will just give it up for the 3 gentlemen who have agreed to spend their Saturday mornings with you at no charge, 1 hour apiece. And you can always email me at team@tradethirsty.com and give me suggestions of topics that you would like covered in our masterminds, or of course speakers that you're well acquainted with that you think would everyone could learn from. Today we have our lineup starting with Mr. Adrian Mans. He and his wife Julie are good friends of mine. He is CEO of TraderInsight.com. And we drug him out of bed this morning. I think he's headed down the same road your old pal Janette is on with her sickness. So hopefully he doesn't cough on you too. Mark Chapman is also new to Trade Thirsty. He's with Forex Traders Daily. He's new on the scene. Very interested to hear his presentation. And then we're going to round it out with my good friend Stephen Primo over at Specialist Trading. All right, so Adrian Mans is up first, and his topic is how the first hour of trading can be the best of the day, and I'm in complete and total agreement with that. Used to be my favorite hour. So Adrian, I'm going to make you the organizer, which will give you the power to talk and to show your stuff. And I just want to remind all of our speakers today that when you exit, if you will please don't close the room. If you'll give me just a moment when you end your presentation, I will close the room or remove your access so that you don't accidentally shut the room down for all of our guests today. All right, so Adrian, you're about to be the ball, my friend. Hang on. There we go. Make you the presenter. And so you can mic up now. There we go. I see your screen. First hour trading tactics. Oh, I hear you. Can everybody hear Adrian? Just real quick, each little housekeeping, each speaker will have 1 hour. So we have 3 speakers. We'll round out around 12 Eastern. Around lunchtime we'll be done today. We are recording today's event, but as you know, technology fails sometimes when you really want it to work. So we don't guarantee the recording, but if and when we get it produced, if nothing fails, we'll get it out to you probably no later than Monday or Tuesday. So Adrian, you can take it away, and you have 1 hour.
All right, guys. Good morning. Thank you, Jeanette. As Jeanette told you, I am out in Los Angeles, so it's mighty early here, but this is the time of day that we generally get up to trade. And one of the reasons that we decided to focus on first hour trading probably 10 years ago or so is that it frees up the rest of the day for us here. So we've got a bunch of stuff that we do over the course of the day. Most of that is automated. First hour is the time of day that we focus on just knocking some things out ourselves. And I would like to go over some of my favorite strategies for that hour and just give you an idea of what it is that we're doing. So first off, I'll tell you about us. For those of you who don't know us, Julie and I have been trading together since graduate school. That was back in 1996 that we started. 1996, 1997 is where we really got going. And we got married in 1997. We got done with our doctorates, and, our parents would be proud to know that the only thing we've ever done since graduate school was traded our own accounts. But, life takes you where it takes you, and we've really enjoyed the journey. So we trade from the West Coast primarily. We spend about 4 months out of the year traveling and trading from around the world, and we really enjoyed the life that we've put together, based on this occupation, if you will. So let's talk about those first hour strategies. Let me get right into it, because there's 4 that I want to go over today, so there's quite a few. I'll take questions at the end, since I can't really see the questions as they're popping up here on my screen. I will be happy to answer anything that you have, and then if you decide afterwards that you have something that I didn't cover or something that wasn't clear, just send me an email to adrian@traderinsight.com, and I'll be happy to answer that for you. So back in 2001, I wrote a book, and the book I wrote was about the trading that we were doing. It's called Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. It's written around a baseball analogy so that it'd be easy to remember the setups that I was talking about, and be easy for us to remember them, as well as for people who looked at the book. I mean, we're both researchers, we're both writers, so we wanted to have some sort of a record of what we were doing. And that baseball analogy, for better or for worse, we did it, and people who love baseball love the analogies. People who don't really get some of them sometimes. If you don't like baseball, then just pretend the analogy's not there and focus on the statistic that I'm going to talk about next, because it's a trade that is called the Baltimore Chop Opening Gap Reversal. Now, the reason it's called Baltimore Chop Opening Gap Reversal is that there was an old Baltimore Orioles trick that looks a lot like the pattern that we're going to talk about here, and was also very effective, just like the pattern that we're going to talk about here. And essentially what happened was, when they had a hitter who wasn't maybe the greatest runner in the world step up to the plate, what he did was knock the ball down into the ground. It popped up high over the pitcher's head, and the batter was able to score a single. And that's an awful lot like the Baltimore Chop Opening Gap trade that I'm going to tell you about right now. So this is a favorite trade of ours. We trade it. Guys who come to boot camp, they love it. We're starting one of our boot camp events this year, this afternoon, actually. We do these twice a year, and people love this particular trade. Excuse me. So if they can focus on something in the first hour, it's usually going to be this thing that draws their attention right out of the gate. Happens in the very first bar of trading, right? The first 5-minute bar of the day. But in order to get your head around what it is that you're looking at, you just need a couple basics in place. So we start with range and true range, all right? Because there's an opening gap trade, and it's a statistical manipulation of market data. And if you're a statistician, then if you're one of the engineers who tends to gravitate towards this thing, or someone who's got some statistics in their background, that any time that you're looking at something using statistics to analyze the data, the best thing you can do is get as close to the phenomenon that you're actually interested in as you possibly can when you're running that statistic, right? So if you're measuring the effect of something, you want to make sure that you're measuring something that you're interested in versus something that's too far removed from it. And I'll show you what I mean by that. So a range of a stock, right, you all know what that is. That's just the high minus the low. So today's high minus today's low, that's going to be the range on the session. So $50.10 down to $49.40, that gave you a 70-cent range for the day. Now that's not what we're interested in, because that doesn't include gap data. True range, right, is going to be the greater value of the high minus the low, or the absolute value high minus the previous close, or the low minus the previous close. So what that allows you to do is it takes today's high price minus the low or the closing price of the previous day. So if we had a 50.10 high and a $49 close the previous day, then we've got a true range of $1.10, and that is going to include the gap, and then that's what we're plugging into this formula that I'm going to show you next. So you've got some assumptions when you're working with statistics, and the first one is that you got a normal distribution. You just have to take my word for it. Market data is going to be pretty normally distributed. And the second thing we're looking at here is that true range is a proxy for volatility. It's because you're going to use true range as your volatility measure when you're putting the statistic together. So back in the late 90s, we tried everything from the implied volatility of the front month contract right down to measuring, true range intraday, and bounced this statistic around a bunch of different ways, did a bunch of Mancovas and covariate out a bunch of effects of things, and figured out the easiest thing to do is just a simple thing, and that is to use true range as a proxy for volatility. You're working under the assumption volatility is mean reverting. There's a bunch of work out there that shows that market volatility is in fact mean reverting. And if you've got those three assumptions in place, then what you get is access to this thing, is standard normal distribution, and this is the statistical Megillah that says you've got a good probability of something that you're looking at moving back towards an average. All right, so one standard deviation out from your average, in this case average true range, is going to be 68.2% of the volatility that you can expect to see. Two standard deviations out gives you 95% of the volatility that you're expecting to see, and that's what we're interested in when we're talking about mean reversion. So if we get a 2 standard deviation gap of true range on a stock any given day of the week, then what we're looking at is a very, very high probability that we are going to have a mean reversion. And all mean reversion is that black line in the middle there. That's your measure of central tendency. That is your mean, your arithmetic average. You got these red balloons here. Those are periods of high volatility. Blue balloons, periods of mean reversion. Does that mean that every single time a stock gaps, it's going to make a move back towards that average? No. It means that many times when a stock gaps, it's going to have a 2 standard deviation gap, and it's going to make a move back towards the average. A lot of times, back toward the average does not mean back to the average, right? And it also does not mean you're going to close the gap. What it means is you've got a very, very high probability that some of these setups I'm going to show you are going to play out the way that I'm going to show them to you. The formula is really simple, right? So the standard deviation formula that I'm using is just going to be, there's a very simple thing to plug into Excel. If you're using TradeStation, you can run this in TradeStation, calculates it this way. The standard deviation is just the square root of, you take x minus x bar for 10 days worth of data. So that x is the true range of today, the true range of yesterday, the true range of the day before yesterday, right? So you take each one of those days and subtract the average of those 10 days. So you're doing 10 days worth of data. Each one you subtract the average of the 10 days. You square it to get rid of a negative number. Divide it by 10. Take the square root to get rid of that square, and that gives you 1 standard deviation for 10 days worth of data. We're going to be interested in 2 standard deviations. You saw 1 standard deviation is going to give you some statistical probabilities. 2 standard deviations gives you a really, really good probability of having a good outcome. So the way this calculation goes, right, your software is just pulling. So if you're using TradeStation, or if you're using Metastock, it's just embedded in the software. You can write up the code and have the software do it. If you're using Realtek, then you can have Realtek pull this out to an Excel spreadsheet. That's what I do. And it goes day 1 through 10. Those are the true range values, not the average true range, the true range, right? So for each day you've got true range. Then you go and you start plugging this stuff into the formula. So each one of those values gets popped in as an X value, right? It's going to subtract the average. I just want everybody to know what the calculation is, right? Your software is going to do this in the background, so it's not You don't have to do this in your head or anything on the fly. Dividing it by 10. Standard deviation in this case with this set of data that we're looking at here is 49 cents. So one standard deviation is 49 cents. That means two standard deviations is 98 cents. And we're going to add that to that average, and that's where we're going to get our gap from. So the rules, we're looking for bulls or bears are going to gap the stock open. They're going to send price two standard deviations up or down, and we're going to enter the trade just above the high or below the low of the deepest bar in the gap. So what I mean by that is when I'm looking at a gap open, I treat that very much like a pullback. So when I see those bars, let's say on a gap down, start moving lower, first bar is going to be my entry bar, my presumed entry bar on an open. Then if the first bar doesn't trigger an entry, the second bar is going to be the next deepest bar, right? As long as they keep moving down on a gap down, lower highs, that's always going to be my entry trigger. So these are 5-minute bars, right? This is an ideal kind of a version of what we're looking for. And we see a stock that closes sort of up in its range the day before, makes a gap open the next morning, right? Assume that's two standard deviations. And then you start seeing bars that are collapsing behind it. This is what I mean by the deepest bar in the pullback or the deepest bar in the gap. So this bar down here, that's the lowest high that this stock made this morning. So I'm going to look to get long in this case right above the high of that bar. And then what I do is I target the open of the first bar of trading, or I'll target the high, something significant that happened in that first bar. You want to go back and look at volume by price when you're picking these apart. And, you can see, generally speaking, the open is going to be the heaviest volume of the day, of course, because that's where most of these stocks are, doing the majority of the printing right off that gap. I should also say most everything that I'm looking at here is going to be S&P 500 or S&P 400. So they're going to be very liquid. And, when you're targeting that open, you're targeting a place that a lot of stuff happened. There's a lot of bodies buried right around that open. And for the most part, you're not hanging around trying to fill the gap. You're just trying to get to that target price and get back out again. And remember what I said about it looking like the baseball pattern, right? So you got that pop to the downside, followed by the spike up. And of course, the spike up is where you are looking, in this case, on a gap lower to make your profit. So let's have a look at the data from that ideal example, right, from that table that we just had there. So in that case, when the stock gapped, right, with the morning gap, and we remember one standard deviation was 49 cents, two standard deviations was 98 cents, right? So we take that 98 cents and we add it to the average. The average was $1.25. So you had an average true range of $1.25. Two standard deviations was 98 cents. So two standard deviation plus that average, $2.23 is the required gap. So that's what your software is filtering for. And when it finds it, lo and behold, this stock gap was $2.84, so we're on, right? So the next thing that we do is shift into our 5-minute chart, and we see that in this case we had an open, and that first bar was the deepest bar of the pullback, right? The deepest bar of the gap. So all I'm doing is I'm putting my orders out there right off that first 5 minutes of trading. I look at the first 5-minute bar. I say, okay, the low of that bar is right here. I'm going to put an order into short in this case, right below the low of the first bar, and then I'm just going to get out on a reversal, right? So I'm just looking for a reversal of two closing prices in this case because I don't have a whole lot of opportunity to say, well, I'm targeting the open or I'm targeting the close or whatever, because the first bar is the bar that I'm getting in on. So I've got some alternative targets that I'm going to talk about in a minute too, but this is just a real simple way of trailing a stop in behind. If I reverse two closing prices, boom, I'm out. So here is a more typical example, especially the way that they're happening recently. They tend to gap and then they follow through on the gap a little bit. It makes for an easier entry, right? So if you're one of the guys in our trading room, then this is what we call an easy entry. I mean, they're not necessarily cliffhangers every day. You know, a lot of people are used to gaps being some pretty wild trading, but in a lot of cases, these are very, very conservative trades that, you've got very good reward to risk ratios on, and all you're doing is just following some pretty simple rules. So in this case, we got a 2 standard deviation opening gap. And then we see that way down here is the deepest bar, right, of that gap open. So in this case, we are going to have an entry in the next bar when it violates that high, and our target is going to be right up here. So this is something that happens very, very frequently, that these targets wind up being just spot on. You get up to that opening tick, and you find out, that is where the volume is really going to overwhelm it when it tries to reverse. Makes for a very, very good profit target. And your stop loss is going to be right below that deepest bar. And then you just have to do some math pretty quick. You always want to make sure that you're on the right side of these things. I always want to make sure that you've got at least a 1.5 or a 2-to-1 reward to risk ratio, because these can be volatile and they can wind up stopping you out. Just because it's going to revert to the mean, or just because it's highly probable that it's going to revert to the mean, doesn't mean that you're going to be able to endure the pain on the way there. So you have to make sure that you've got a stop that makes sense, and a target that makes sense, and then a ratio that makes sense. And then these are very, very easy to set up. So what I'm doing with these is, in this case, for example, my entry is $25.89. So that's my stop trigger, right? So I'm doing a stop limit order on this, and I just set this up and bump that price down as the stock is ticking lower over the course of the morning. So first bar of trading, my entry would have been up around $27.39, right? Second bar of trading, my entry would have been $27 and maybe $10. Third bar of trading, $26.70. So as I'm following it down, I just keep bumping that stop price lower. And my limit price represents the worst slippage I'm going to take, $25.92, right? So I'm looking at a 3-cent slip is all I'm willing to accept here. My profit target, $27.08. That comes from that opening tick. And my stop loss, of course, below the low, $25.59. So depending on the share size you're trading, right, you can just divide that down, right? Somebody's always going to say, well, I don't trade that many shares. But even if you're trading 100 shares, this is going to be a nice opportunity to make a little profit. And as you bump these up, as you get more and more profitable with them, then and more comfortable with them, then you're going to see exponentially better results. But typical trader in our room is doing probably 500 shares on these, and these are far and away going to be their favorite trades, because the reward to risk ratio, as you can see right there, is always going to be in really good shape, at least 2-to-1, if not 3 or 4-to-1. So with the money management on these, the big thing for me is getting to risk-free trading as fast as I possibly can. So once we got the position on, what I'm looking for is a move that's 50% of the distance from the entry to the target. Once I've got that, I trail my stop at break even. If it moves strongly in my favor, then I wait for that initial target to be achieved. I take off a portion of the trade, and I trail the balance at 50%. So I've always got money management rules that are in effect. Julie does a lot of the money management here in our office. She'll just tell me, okay, time to move the stop on this one. I'm busy getting into other trades, the trading plan trades and all. But for the most part, we've got it locked down to where we know exactly what we're going to do before we do it. So the initial target for a gap down, either going to use the high or the open of the opening bar. Initial target for a gap up, going to use the low or the open of the opening bar. And then what I also do is I use pivot lines and fib retracements to develop alternate targets and some alternate entries, I have to say. So in this case, right, Kroger, just have this one here because this is a nice example of a fib extension target. Stock gapped open. We got to move right around that R2 pivot line. Went up, got to a fib retracement line that made for a nice early entry, and then we had a target that got us down to, in this case, 59.74. Right, the 382 expansion is the place that if it triggers in the first bar or the first 2 bars, I always tell the guys, hey, look for the fib expansion and see if see if that doesn't make for a logical target, as opposed to trying to go all the way down to that R1 line, the blue line there. That would be a little bit of a push for an extension. And as far as which fib line, I usually take the more conservative, the 382. Here's another one. There's a pivot move. There's another way that I set these targets. So in this case, you got a 2SD open. This one gaps it right down below S2. And when S2 and S1 are bunched up like this and a stock makes a nice move in the first bar of trading, then I'm generally looking for the opportunity to get a target at that next pivot. And then, of course, 50% of the distance to the target, I'm already trailing at break even. So there's nothing lost if this thing would have turned around and stopped me out right at the entry price. So a lot of the guys in the room are trading smaller dollar accounts, and they're more comfortable when they start anyways doing these things on sub-10s. And on the sub-10 stocks, the only difference is going to be that we take these in either direction off that opening gap. So if you're trading low dollar stocks, I've really only got this in here to tell you that they are not as likely to follow through on a reversal, right, on a mean reversion kind of a trade. But when they gap, and they gap 2 standard deviations, the volatility that comes into them usually makes them a good candidate for a move above or below the extreme of the first 5-minute bar. And what our guys are doing is they're just taking very small targets. They're doing a 10-cent profit target, a 3-cent stop loss, and they do these in the first hour of trading once again. And they tend to clean up with these trades. I don't trade them this way. I've got them here just because I know that this is a way that a lot of the newer guys like to set these up. They've got a high probability for success. I don't like to bother with the sub-10 stocks all that much, just in my personal trading. But, if you're trading with a smaller account and you want to be able to put on a bunch of shares and get in and out quickly, then this winds up being a pretty good strategy. So I've got it here. Again, you get a big gap open. And in this case, what Ken and the guys are doing is they do they'll just put a bracket around that first bar of trading, and then whichever direction it breaks first, right, a violation of the top or the bottom, and they've got a profit target at 10 cents. They had a stop loss at 3 cents, and they wind up making money more often than not. So it's been a strategy that's worked out well for them. I find people kind of get a little burned out on these sub-$10 stocks, but initially it makes for a pretty nice strategy, right? Once again, gap open. Here we go. You get a violation of the top of that bar, profit target, stop loss, right? It's all in place ahead of time, and they're setting all this stuff up with those bracket orders that I just showed you. If your software doesn't support bracket orders, you can also go ahead and use conditional stop limit orders. They'll work just as well. Now, the next strategy that I focus on personally is something I call intraday range scalps. So in this case, I'm focusing on some volatility bands that I can just eyeball on a chart. I teach the guys, how to find the most significant price activity over the course of a session, and we're going to look for. Remember, a couple of years ago, there was that thing that people were buying that was about channeling stocks, right? So you were looking for channels that stocks traded in, and you were just looking to play the price activity as it bounced around in there. This is pretty similar to that. So you're looking for parts of a day where you can identify very, very clearly. You can say, wow, I can see right there price really bounced around inside that range. The top of that range held it. The bottom of that range held it. Well, tomorrow, it's very likely that if price gets into that range again, it's going to constrain just the same way that it did the previous day. So we focus on ranges that have real clear support and resistance. And here's the important thing when you're setting these up is you don't want to get greedy. So you don't want to say, well, geez, because any one of these charts I'm going to show you, you're going to say, well, you don't have to limit those ranges to 20 cents. You could take 40 cents or 60 cents, right? Because that's the 3 bands worth of range that you're talking about, and you've got a pretty good chance of hitting those numbers. And you do, but I'm going to tell you, you've got a much better chance of just always hitting singles with these, right? There's that baseball analogy again, always hitting singles. Going to be much, much more consistent than trying to swing for the fences. So you're looking for swings of about 20 cents. And most of the good candidates you're going to see have range of about 75 cents to $1 at least on a typical trading day. And if you're going to trade the open, what you want to do is limit the stocks that you're focusing on to things that trade 10 million shares a day or more. So this is a very, very high liquidity trade. You're looking at the Apples of the world, Netflix, Gilead. You know, those are the frequent flyers on the trading plan that I put out. And you know, it's pretty straightforward in terms of how I go about trading these. So I'm going to show you how to set them up in a second so you can figure out how to do your own. If you're used to looking at this trading plan, then you know every day what I do is I set up 3 bands for each one of the stocks that I'm interested in. In this case, I'm interested in Apple on the short side of the market. That's because it closed below its open the previous session. 98.52 is my first entry. 98.30 is my first target. 98.30 is the second entry. You know, it's the alternate entry 1. And 97.85 is going to be that alternate target 1. And then alt 2 is going to be 97.85 down to 97.35. So that's a bigger move, progressively larger moves on this day. And the way that these were put together, you can see here, I just went through and identified where price was bouncing around. So look at the right side of the chart, and you're going to see that what I've done is snapped support and resistance lines in my software, and I just go through and eyeball these things. And I'm looking for where there's a lot of highs, lows, opens, closes that tend to aggregate, especially going into the end of the day, because the time of day we're going to trade these is the beginning of the next day, right? So the price activity going, you know, right into that last trend of the session, that's going to be where we sort of find our sweet spot for the first hour of the next day. And then the way that I pick which one of these bands I'm going to focus on around the open is, you know, you're trading a stock like Apple. This thing's highly liquid, so it's going to be highly liquid before the opening bell. You're looking at pre-market data, and I'll say, well, gee, you know, pre-market, the following session, it's trading up at $98.65, let's say. So I'm going to focus on that 98.52 band. Or if it's trading $98.40, I'll focus on the 98.30 band. And I just set up some conditional orders that say, well, if it's coming down through that band from above, get me short and get me a target of X cents, right? So in this case, if it's coming in from 52 to 30, I'm going to say get me in at 52, get me out at 30. That's my target. 30, I'm going to look for 85. 85, I'm going to look for 35. So I've always got these bands in my head as far as where I think price is going to go. Holds up best right around that opening bell, right? So 97.85, look what happens, right? It opens right above that. And if you guys, you know, if you take me up on the offer at the end of the presentation here, then I'm going to include all the trading plans as sort of bonuses for the course that's being offered. So you'll be able to look at these over the course of a month and just sort of play through with them. You know, even if you're not interested in the plans after that, you'll be able to just look at how I structure the plans, and you'll be able to get a whole bunch of ideas on how to trade these yourself. You know, just from following through and looking at them every day. But here you see it, you know, before the bell opened, or before the opening bell, obviously, you had a print up above that 97.85 line. You set up your trade ahead of time, and you just tell it, you know, 97.85, I've got a 50-cent target. It's going to take you out if you're doing a bracket order. It's going to take you out at that 35, and you're going to be not so happy when it goes down to 96.06. But for us, this first hour stuff is all about, we just load them up and go, load them up and go, load them and go, load them and go. So one trade after the other, and we're not looking at, boy, did we leave some money on the table? You know, did we miss something? Then later over the course of the day, right, as it comes back up again, sometimes we'll use resting stops at these support and resistance lines, especially when it looks like price is going to exhaust. I prefer to see this kind of a thing where price came down through, went back up, and you have sort of this check mark move to the downside, right? So you had a move up above 97.85, and then again it's headed down towards 97.35. You've got travel range. The stock's already done on the session. You know what the path of least resistance is, and then look, that second time, you know how 97.35 reverses it, right? So the range holds up over the course of the day, and this makes for some very, very easy then scalp trading, and much more structured scalp trading than just watching the ticker all day long. Here's Gilead, GILD. This one's also on this trading plan quite frequently, and you see it'd be very easy to say, well, Adrian, why not just say 93.57 all the way down to 92.12 is what we're looking for, and get that bigger move over the course of the session. But it's because your pre-market data or your opening bell is going to give you an opportunity to enter someplace, and it's not necessarily up above 93.57. In this case, it's at 92.67, and I've got a real easy move then down to that target. Yeah, it goes down to $91, but over the course of the day, I'm just looking for these real easy to identify kind of entries. Again, if it gets 50% of the distance to the target after it gets me in, and then winds up going back up again, I'm just going to stop out at break even. So that first check mark, that inverted check mark there, that thing didn't get down to the profit target after it got me in, got me out flat. The second one gets up above 93.14, nice move down to 92.67. So this is going to be, how these things play out over the course of a day. So first hour is going to be the most reliable on these. Course of the session, I would just say if you're going to keep watching those same bands from the previous day, what you want to make sure you do is go through and account for what's happening intraday today, and see to it that if there's new bands that are setting up, you allow for those, and you're not just stubbornly saying, well, yesterday it did this, so this is the only thing that I'm gonna watch, because they tend to sort of fall apart a little bit as the day moves on. One more here, Netflix. This one's on a lot too. So the caveat with something like Netflix, much bigger swings over the course of a session typically, right? So in this case, we see, we've got the entry opportunities that are lined up exactly the same way. If you are taking the, 107.14 entry, you've got to move all the way down to 106.34, and over the course of the first 15, 20 minutes here, you got to move through all of those bands. The warning, the admonition always is the same. Don't get greedy on these, right? Don't lament the fact that it moved all the way down to 102.56 and you missed it. The key with these is these are scalps. These are set up to be scalps. You're anticipating a scalp. You're anticipating making, a very fixed range kind of a move. And as long as you did what you said you were going to do, then that trade is a success. All right, so lots of movements between those bands. Now, another thing that we do, that we do quite a bit in our trading room is we do these news-based trades. All right, so when you're trading news reversals, the key is to make sure that you're on the right side of the trade, and that generally means you're fading the herd. So when you get a bit of news that hits the wires, first thing you have to do is decide, is this news that I want to be trading? In the case of takeover chatter, right, I find that it's a very reliable fade. The rest of the news is going to be a little bit harder to trade. It's, when I hear things like, CEO, he went down to Tijuana and killed somebody, and that's a game changer. That's a totally different situation than some rumor that's floating around on the wires. Most typical rumor that I'll see is this chatter about a takeover. This is the kind of movement that then happens. These happen probably 2 or 3 times a week. We call them live. I've got a little bit older data here on these news alerts, because they don't want recent alerts being used for for freebie sessions that we're doing. But the theory is the same and the practice is the same. You're looking for a big move. You want it to happen right around a pivot line. In this case, we've got 65.29 up above. We have a real easy support and resistance line that we can spot down around $64.90. So what I'm looking to see happen is a move up to the pivot. Once we get to that pivot, the stock hesitates, breaks down below the pivot, and then my target is going to be $64.90. And in this case, my my stop on this thing would be right up around 65.55, right above the high of the bar that breaks above that pivot line. So you get these things popping up. This one in particular is from Trade the News. I know Trade the News for intraday traders is a very valuable resource, especially if you're trading other things. If you're trading futures and things, you can get the information from the pit. You can also use the fly on the wall. Fly gets really, really good takeover chatter. They come out just about in time, same time with the Trade the News wire. So this gives you then a real logical entry, right? You're just moving down below there, and then you've got a very, very logical place to go and target for the trade. And again, you're not worried about money leaving on the table. You're just looking at, this news coming out. Is it close to a pivot line? If it's close to the pivot, when I see it move up and through, I'm going to wait and see if price starts to slow down. If the price activity starts to decrease when it's going up, you start seeing less volume, then I know that there's a high likelihood it's going to reverse through that pivot line and give me the opportunity to go short. So these are always going to be on the short side of the market. That's the other thing, right? You see a big pop like this, that pop to the upside accompanied by news. It says 6:40 there because that's a time of day that we're trading. That would be 9:40 your time if you're on the East Coast. You see the speculation there's going to be a takeover. Got to move up above. Price starts moving lower, coming down onto this 61.56 pivot. So that's a floor trader pivot again. That's R2. We're going to set our threshold right below this line. And when we see price move back down in there again, right, that gives us an entry opportunity on the violation below 61.56. First target's going to be natural support and resistance from earlier in the morning, right? And again, I just eyeball these things. You can go through and do volume weighted average prices based on time zones and things. You can do fib retracements. You can do a bunch of stuff. I like to keep this real simple so that I can have a very, very easy target to go and gun for. And in this case, the first extension is going to be that blue pivot. And if I was going to have a second extension, right down to the central pivot. And now let's do one more because I know I'm getting close on time here. This one, another gap or another pop to the upside, right? Sometimes you see them, they'll do these 2 pivot moves, sometimes 3 pivot moves, and then we get a move down, right? And in this case, it looks like, well, geez, we missed the opportunity to enter. The news came out, the news popped the stock, and by the time we saw the news, it was already down at that 39.70 point on the bar. What you have to do is just watch it for a few seconds because, sure enough, it goes and it makes that move higher, right? Spikes up. And this is very, very typical of the kind of thing that we see on these news events is that there's a lot of volatility. And when it comes back in again, right, we've got an entry opportunity right below that 39.92 pivot in this case. First target, $39.41. Second target, $39.12. So these are real easy reversals to play, and it's all part of our first hour trading strategy. And the gap course, this is going to be the thing that most of you are interested in. So for $99, I've got a gap course. Gap course is going to take you through and teach you the entire methodology of how to go and set up those opening gap trades, how to go through and play those every single morning. So that's great that you learn how to do it and you know how to find them. What's better about it is we're including everything that I do for a month for that $99. So I've been a professional trader since 1998, I guess, which dates me. I've been doing this for a very, very long time. My wife and I have been trading together for a very long time. We've always sort of been in this education space too. We love it. We love interacting with people. We love talking to people. So you can see the whole Megillah, everything that we do every day of the week as part of the course. So you take the course, you learn how to trade the gaps. Then you come into the room for free for a month. Everybody in that room, for the most part, the guys in the room come from, all the moderators anyways, are guys who have been through the training, guys who have been through boot camp, and they all really know what they're doing, and they all trade for a living. So you're going to see that some of them focus on the trading plan, and so that you're not in there saying, well, what's the trading plan, or what are they trying to sell me here? I'm just going to give you the trading plan for the 30 days that you're in the room. So for 30 days, you hear Rick, or you hear me, or you hear Ken or Julie, or one of the guys talking about, one of the trades on the plan's coming up. You're not saying, well, what the heck are they talking about? I don't want to get front run on these things. What's going on here? You've got the plan in front of you. Plan has the entry, the stop, the target, everything, the money management, everything is right there in front of you, so you know what we're talking about. You get the first hour scalper plan as well, so you know all those levels that we're talking about. When we say we're getting into a trade, you're not waiting for us to tell you. You've already got it on the table in front of you. You know what it is that we're going to do. And then if you're looking at that and saying, well, holy smokes, he's giving me a lot of information here. I don't know how to trade these plans. There's videos on the site, right? When you log in to get your plan every day, there's videos on the site that show you how to trade it. And then, like I said, the best part about it is you're in that room every single morning. It's a first-hour trading room. That's all we're doing in there. It really starts to, you're going to see about 30 guys who are working together every single day, who talk to each other about the setups, about this exact style of trading. And when that hour's up, we're all headed out and doing something else, right? So in my case, I'm either going up and I'm hiking the mountain here. We live at the beach in Pacific Palisades, which is, right just a little south of Malibu in California. My day is I either go hike the hills, or I head down to the beach, go for a walk on the beach, go surfing, or we head out to the mountains to go skiing. When our 8-year-old has his say in the matter, then we're off to the ski slopes. But first hour of the day is the thing that we like to focus on the most. It's the thing that we like to focus on the hardest. And if you'd like to learn what it is that we're doing and get 4 weeks of all this additional training included in the offer, then this is your chance to have a look. I have never had somebody come back and say they did not like that they took advantage of this offer. Every single person has enjoyed this thing. And if you have questions about it, you just shoot me an email and tell me that there's something you don't understand, or there's something you want to talk about. And then typically what I do is I don't really like to communicate via email, so I'll just send you my my cell phone number and just have you send me a text, and I just respond and say, I can talk in 10 minutes. And then usually what I wind up doing is talking to you from the beach or talking to you from the hike. So that's me, and that is the trading that I do. And I would like to give you guys a few minutes here to answer questions. And then I've actually got to go and get myself headed to a boot camp. So let's take a look here. You can find the books on Amazon. So that's pretty straightforward. Just search for Adrian Manns, and you'll see I've got a couple books out there. It's Around the Horn, a trader's guide to consistently scoring in the markets. There's also Trade Secrets, Powerful Strategies for Volatile Markets. Around the Horn is sort of a soup to nuts kind of a thing of most of the stuff that I do. And Trade Secrets focuses on expansion of range and volume, which is a fantastic trading strategy if you want to look at stuff all day long. You can also find everything on Trader Insight, of course. The baseball analogies, that's in Around the Horn. So really the easiest thing to do, I guess, is just go to traderinsight.com. Trader Insight or Amazon, any one of them. Do I recommend, I'm going to go backwards through these. Let me say I should probably start at the top, right? Backwards is not going to work so good. How do you know it's the lowest bar? So that's a question that everybody, well, it comes up a lot, and it's pretty intuitive once you wrap your head around it. You don't know it's the lowest bar of a gap until you go through and have the next bar form. So on the first bar, I've got a presumptive entry, right? So if a stock opens, gaps down, and the high of the first bar is $50, then on the next bar, $50.03 probably is going to be my entry price. but let's say the next bar moves lower, right? Next bar moves down, so the price activity in the bar takes the next high down a little bit. Well, now that's the deepest bar. So then I just I go and pop my my entry price down to the high of the next bar. So you're always just ratcheting in behind. There's no mystery there, no no big secret. So in the room, what we're doing is we're just saying, all right, the entry on XYZ is going to be $50. Our stop is going to be $49.70. Our target is going to be, whatever, $50.50. Then on the next bar, we say, okay, we move down. So now our entry price can be $49.70. Our target is going to be, 50 to whatever. So you're just always ratcheting in behind, and it makes it makes it just a very, very easy way to trail in behind and get your order set up. Is it the same for futures? I've got friends who are trading these things on futures. The things to remember is you have to limit yourself to the cash session, right? You have to be able to find gaps. The range trades, absolutely. So, we've got, my buddy Mark trades these on ES. He trades it on oil. He'll trade gold this way for those scalper band setups. He looks at over the course of the session. Some guys like trading these spiders, diamonds, Qs. It's not the same kind of leverage, but the Qs in particular will wind up having at least that 20-cent range, and that makes for some good trading sometimes. And you'll see those on the scalper plan too if you're looking at that. Use of candles would make it clearer for you. That's fantastic. You and my wife have something in common. I don't think in candles. I think in bars, which is probably something Hubert and Jeanette and I have in common. We do our best thinking in bars, but it's if you see things in candlesticks and those make more sense to you, then just use candles. There's no difference as far as I'm concerned, except that it's what you're used to. And I was just used to open, high, low, close bars, and just have always used them. Do I trade mainly stocks? Yes, I do. I trade primarily, in my own account, I'm primarily trading New York Stock Exchange listed stocks. I think, I told you we both have PhDs. Our PhDs are in psychology. I think that, there's a whole lot of psychology involved in trading in general. And I think that, NYSE and NAS are very, very different animals as far as their personality goes. I think NYSE, the influence of a single designated market maker is still very evident to me compared to a NASDAQ security where, there's other things controlling where support and resistance and, so the value line or the VWAP is going to affect the price action over the course of the day. So I'm mostly stocks. I know a lot of guys are trading futures and options with this stuff, and they're successful with it. More power to you. It's just not for me. Can't short stocks in your account, then if you can't short stocks in your account, then there's a good chance that you can't trade more than 3 times a week in and out in your account, which does not prohibit you from taking advantage of some of this stuff. It just, if you don't have a PDT account, then you have to be careful about how you're doing these trades because you're going to get designated and wind up violating the rule. But you can look for the gaps that are to the downside, and if you're looking just for the downside gaps, then at least 3 times a week you can do a round trip trade, and there's usually gaps and the downside just about every day of the week. Recommend a broker or software. I say recommend best TradeStation. I use Realtick. I'm using Realtick through a couple of brokers. You can use, brokers like because commissions. You use Trading Block Pro mission structure, and they'll get Realtick. You can also use. They've got Realtick available, and they've got some pretty good support on their end. Has my stuff been affected by HFTs or algorithmic trading? Yes. but I would say only to the extent that it's on the regular part of the trading plan, the bigger part of the trading plan. What the effect has been is it's narrowed those profit targets down. So it used to be the case that our profit targets on the core portion of the plan, right? You see there, that's the one that had 96 straight months of the track record on that thing was just profitable. But if you look at those profits, you'll see that back in 2008 or back in 2006, the profit target on a trade could have been 90 cents or over $1, whereas now the profit targets on the trades tend to be 40 and 50 cents, just because of all the HFT stuff and all the algo stuff that's going on. And I do, I told you I program them up myself, so I'm taking advantage of the ability to do that. And a lot of what I do targets what we know HFT shops or ALG shops are also going to be doing. What causes the gaps? The gaps that we're looking at are, they're primarily caused by news events. So they're typically going to be earnings announcements, earnings misses, earnings, things that the market tends to overreact to around the opening bell. Company misses and misses by a few cents, and then the stock gaps way down, or the company beats by a couple cents and gaps way up, and then as soon as the institutional order flow is out of the way in the morning, the thing starts fading in the other direction. Let's see here. How did you do the first Monday 1-4 when the market declined? Well, I'll tell you. If you look at the trading plan, if you look at the so when you take the gap course and you get all this membership stuff, you're going to see in the members area when you log in, you'll see the daily income trader service. And then the around the horn plan is that structured trading plan that goes along with that. And what you'll see is there's a track record goes all the way back to 2006 that you can look at. You can also look at every single trading plan going back to 2006. And what you're going to see, I make no bones about it, is that on the days that the market makes its biggest move to the downside, I tend to see the biggest profitability. So the short side trades, it's definitely skewed to the short side. In terms of profitability, they fall a lot faster than they rise, right? And I've got a lot of trades planned around shorts. So when I'm lucky enough to see a big down open like that, then it tends to be a pretty good day for me. You can take advantage of the offer. You've got the link there. The offer will be there for the next 30 days. Is Scottrade worth using? I prefer using a direct access broker. So I like the light speeds and trade stations and trading blocks of the world better than I like the Scottrades and Ameritrade. Just look for the 606 report on your broker's website. You can see how much of the trading, how much of the clearing that they do is directed orders versus non-directed orders, and if the majority of what they're doing is non-directed orders, then what you want to do is go ahead and call them and say, well, is there a different commission structure that I could be on that allows me to direct my orders so that I'm not getting filled on the broker's book? You want to get filled based on what's going on in the market, not based on where the market maker is willing to fill you. How is stock trading like a pro different than the gap course? If you're talking about there's a first hour course on there that's like a half-day course that goes through and shows you over the course of 4 hours. We go through in great detail every single one of the first hour strategies. So that's the same one that you'll see me do at if you're coming to the Traders Expo and you're taking part in there. I think it's $450 or $495. That's what we're going to be doing there for that half day.